Let me start with a very simple question. A company publishes a climate or sustainability statement and tells investors that the issue is material. What happens next? How does that sentence become a number, and when should an investor trust that number enough to change a valuation model? That is the entire purpose of today's session. We are not going to spend 90 minutes memorizing reporting frameworks or comparing ESG scores. Instead, we are going underneath the disclosure. We will follow one claim from the moment management makes it, through the evidence and assumptions behind it, into the financial statements, and finally into an equity valuation decision. The sequence you see here, claim, evidence, assumption, financials, valuation decision, is the pipe we will use throughout the class. If you remember only one thing at the end, remember that a sustainability statement is not automatically an investment signal. It becomes useful only when we can explain the economic mechanism that connects the statement to value. Here is the promise for the session. By the end, I want you to be able to read a sustainability disclosure and ask a sharper question than, is this good or bad ESG? I want you to ask, where does the money show up? Take the example on the slide. Carbon pricing may materially affect operating costs and investment requirements. That sounds sensible, but it is still only a sentence. Before I put anything into my valuation model, I need to know the mechanism. How many tons of emissions are exposed? Which carbon price? In which country? Over what period? Can the company pass some of the cost to customers? Can it reduce emissions through investment? Once those questions are answered, the statement can begin to affect EBITDA, capital expenditure, free cash flow, the cost of capital or terminal value. That movement from disclosure sentence to financial mechanism to valuation input is what makes sustainability information investment grade. There are 5 practical abilities I want you to leave with. First, you should be able to decide whether a sustainability issue is genuinely relevant to enterprise value rather than assuming every disclosure deserves a valuation adjustment. Second, you should be able to trace a risk or opportunity to a financial line item. Does it affect revenue, operating cost, capital expenditure, asset value, liability, cash flow timing? Third, you should be able to challenge assumptions. A model can look sophisticated and still be wrong because one assumption is stale or unrealistic. Fourth, you should be able to judge confidence. What evidence supports the number? Who approved the assumptions? Is there an audit trail? Has anything been externally assured? And finally, you should be able to change the right valuation variable. Sometimes sustainability affects cash flow, sometimes it affects asset values, sometimes it changes financing conditions or scenario probabilities. The goal is not to add an arbitrary ESG discount. The goal is to adjust the economics. This slide is the mental model for everything that follows. Start with the claim, what exactly is management asserting, then ask for evidence. What data, documents or observations support that assertion? Next come assumptions. Evidence rarely speaks for itself. We still have to assume a policy path, a price, a technology cost, a demand response or a timing profile. Those assumptions produce an economic effect. Perhaps costs rise, demand falls, capex increases or an asset becomes less valuable. Only then do we ask where that effect appears in the financial statements, and after that what changes in our valuation model. Notice the order. Valuation comes late, that is deliberate. If you jump directly from a sustainability headline to a valuation discount, you are skipping the analytical work. So throughout the class, I will keep asking you to move one step at a time. Claim, evidence, assumption, economic effect, financial statement, valuation. That is a more disciplined way to think than simply labeling a company sustainable or unsustainable. We will use one fictional company for the whole class, Northbridge Industrial PLC. It is a UK listed industrial manufacturer with about 2.8 billion pounds of revenue and 18% EBITDA margin, roughly 420,000 tons of scope 1 and 2 emissions and 650 million pounds of net debt. It is energy intensive, sells into European markets and expects to refinance debt in 3 years. Those details matter because they create several possible transmission channels from climate policy into financial value. Northbridge publishes one sentence. Carbon pricing developments may materially affect operating costs and future investment requirements. Imagine you are the analyst covering this company. You have read that sentence in the annual report. What do you do with it? Nothing yet. It is a useful signal, but it is not yet a valuation input. Our job is to turn that sentence into something testable. We will ask what is exposed, what assumptions management is using, how much the effect might be, where it appears in the accounts, and whether the evidence is strong enough for us to change our model. Let us slow the sentence down. Carbon pricing developments. Which developments? UK policy, EU policy, a voluntary internal carbon price, a market price for allowances. Each one produces a different number. Then we get the word materially. Material to what? Revenue, EBITDA, cash flow, asset value. Management may be using materiality in a reporting sense, while the analyst needs to know whether the impact is large enough to change expected value. Operating cost is also broad. The effect could appear in energy cost, direct carbon payments, purchase credits, or supplier prices. Some of the cost may be passed on to customers, some may not. And then we have future investment requirements. That could mean new equipment, energy efficiency projects, electrification, process redesign, or early replacement of existing assets. A single disclosure sentence contains a whole stack of questions. Good equity analysis starts by opening up the sentence and refusing to treat broad words as precise numbers. Here is how we will work through Northbridge. In block 1, we ask whether the issue is relevant to enterprise value at all. Block 2 maps the risk to specific financial line items and makes the assumptions visible. Block 3 is about failure. We will look at how a model can be coherent, well presented, and still economically wrong. Block 4 separates financial reporting from sustainability disclosure and asks what confidence, evidence, governance, and assurance actually earn. Block 5 brings the number into a simple equity valuation bridge. The important thing is that these are not 5 disconnected topics. We will keep returning to the same Northbridge claim. By the end, you should be able to see the whole pipe, not just one reporting standard or one valuation technique in isolation. We begin with the relevance test. Before estimating anything, ask whether there is a plausible route from the sustainability issue to enterprise value. This is a very useful discipline because sustainability reports contain a lot of information. Some of it is strategic context, some of it is operational performance, some of it may eventually affect value, but not yet in a way we can quantify, and some of it directly changes the economics of the business. Our first task is to distinguish those categories without dismissing useful information and without overpricing narrative. A sustainability issue becomes investment relevant when it has a financial transmission mechanism. Think of that mechanism as the bridge between the sustainability topic and enterprise value. Revenue can move because customers change what they buy, because regulation affects product eligibility, or because a company gains or loses pricing power. Operating cost can move through energy, carbon pricing, waste, water, or labor. Capital expenditure can rise because equipment has to be replaced or redesigned. Assets and liabilities can change through impairment, useful life revisions, or provisions. Financing can change if covenant headroom weakens, lenders demand a higher spread, or refinancing becomes harder. The key question is not, is climate important? The key question is, through which channel could this issue change future cash flows or the risk attached to those cash flows? That is the disclosure sieve on the slide: narrative, indicator, mechanism, financial effect, valuation input. The further we move to the right, the more directly useful the information becomes for valuation. Let us test that. Suppose Northbridge says we are committed to net zero by 2050. Would I change my valuation model immediately? Probably not. The commitment gives strategic context, but I still need a credible plan, capex requirements, and expected operating effects. Now consider a £10 per ton movement in carbon price changes annual cost by £4.2 million. That is much more useful because it gives us a sensitivity. I still need to verify the emissions boundary and whether the carbon price assumption is current, but I can see the mechanisms. What about supplier human rights audits completed at 92% coverage? That is an operational indicator. It may matter economically if weak supplier controls create disruption, procurement cost, or customer access risk, but the metric alone does not tell me that. Finally, 180 million pounds of transition capex already approved for 2027 to 2030 is directly relevant to free cash flow timing. This is the habit I want you to develop. Do not ask whether a disclosure is ESG, ask where, if anywhere, it enters the model. It is tempting to divide disclosure into two buckets, useful and PR. That is too crude. Financial materiality changes by sector, geography, strategy, and time horizon. A generic commitment may have low decision usefulness today, but it can become more relevant if management publishes a funded transition plan. A metric without a mechanism may be insufficient for valuation now, but it can still help us monitor execution. A quantified financial sensitivity is more useful, especially if it is supported by current evidence. And a model input tied to evidence and governance is stronger still. So think of decision usefulness as a spectrum. Your job as an analyst is not to dismiss information too quickly. Your job is to ask what additional evidence would move that information further along the spectrum. For Northbridge, the original carbon pricing statement is not useless. It tells us where to investigate, but we are not ready to price it until we understand the mechanism. Now we move from relevance to mechanics. We have decided that carbon pricing could plausibly affect Northbridge's enterprise value. The next question is how. This is where vague sustainability language starts becoming financial analysis. We will build an explicit calculation, inspect the assumptions behind it, and map the result to the financial statements. Start with a simple structure, and here I want the arithmetic to be completely open. Northbridge has 420,000 tons of emissions. At 75 pounds per ton, gross exposure is 31.5 million pounds. We apply an 80% coverage factor, use zero free allocation in the base case, and assume 17% of the remaining cost can be passed through to customers. That reconciles to roughly 21 million pounds, 31.5 million pounds times 80% times 100% times 83%. That gives us the base net annual carbon cost exposure used downstream in the case. The exact number is still a teaching simplification, but it now reconciles visibly to the assumption pack students can test. Once we have the exposure, we map it to the accounts. Direct carbon cost may increase COGS or operating expense and reduce EBITDA. Cash payments affect operating cash flow. If carbon pressure changes the economics of a plant, it can also affect useful lives, impairment assessments, or provisions. Now we have moved from carbon pricing is material to a chain we can interrogate. Emissions, price, coverage, allocation, pass-through, net cost, financial line item. The model on the previous slide looks simple, but every term hides an assumption. That is why I want you to develop an instinct for the assumption pack. First, boundary, which facilities, emissions, and geographies are included. Second, price path. Are we using current market prices, enacted regulation, management's internal scenario, or an external scenario? Third, coverage. Which activities are actually exposed? Fourth, free allocation. Has the model captured the current phase-out rules, or is it using last year's policy treatment? Then comes pass-through. In this base case, we assume only 17% pass-through. Can Northbridge really recover that much without losing customers? That depends on competition, contracts, and customer alternatives. Finally, abatement. What projects reduce emissions? When do they start and are they funded? A credible estimate is not just a number. It is a number plus its boundary, method, date, and owner. If those are missing, your confidence should fall even if the spreadsheet looks impressive. One of the easiest ways to create false confidence is to publish a single neat number. So let us show a range. Under low policy pressure, Northbridge's net annual carbon cost might be about 12 million pounds. Under the reconciled base assumptions, 420,000 tons, 75 pounds per ton, 80% coverage, zero free allocation, and 17% pass-through, it is about 21 million pounds. Under a high pressure scenario, it might reach 35 million pounds. Now look at the fourth number, 8 million pounds using a stale policy assumption. It looks reassuring. It may even be calculated perfectly. But if the underlying free allocation, coverage, or pass-through assumption is out of date, the precision is meaningless. This is why uncertainty is not a weakness in analysis. A well-constructed range can be more decision useful than a false point estimate. The important question is what drives the range. If you can explain the drivers, the analyst can decide which scenario is most credible and how much weight to place on each. Now we connect the sustainability driver to financial metrics investors already use. If Northbridge purchases carbon credits or allowances, operating cost rises and EBITDA falls. That reduces operating free cash flow. If Northbridge responds by investing in lower carbon equipment, transition capex rises. Near-term free cash flow falls, although later years may benefit from energy savings or reduced carbon exposure. If certain assets become uneconomic earlier than expected, useful lives may shorten or impairment indicators may appear that can reduce carrying values and may influence terminal value assumptions. And because Northbridge has a refinancing event in 3 years, carbon related cash pressure could matter for covenant headroom or credit spreads. Covenant headroom simply means the buffer before a company breaches a debt condition. In that case, the effect may reach the discount rate rather than only the cash flow forecast. This is the bridge. Sustainability is not sitting beside finance. Once the mechanism is explicit, it becomes operating cost, capex, asset value, financing risk, and cash flow. So far, we have built a plausible estimate. Now we need to become skeptical. The next block is about a very important analytical problem. A model can be internally coherent and still be wrong. The formulas may work. The logic may be documented. The output may look professional. Yet one assumption may no longer describe the real world. For investors, that is often more dangerous than an obvious calculation error because the wrong number arrives wearing the appearance of confidence. Think of the analytical chain in 4 layers. First is data, emissions, sites, production volumes, carbon prices. Second is assumptions, policy coverage, free allocation, pass-through timing. Third is the model, the calculation logic, scenarios and sensitivities. Fourth is the decision, the valuation adjustment or the conclusion we draw from the disclosure. Errors can enter at any layer, but the most subtle failure is often the assumption layer. Suppose the emissions data are correct and the model formula is correct, but the free allocation assumption reflects a policy position from 18 months ago. The model can produce a perfectly reproducible wrong answer. The warning sign I want you to remember is this. If an important assumption is described as current policy but has no date, no source and no owner, you should be uncomfortable. The wrong number often enters through a plausible assumption, not an obviously broken spreadsheet. Here is a diagnostic you can use in equity research. For every high impact assumption, ask 5 questions. When was it last refreshed? What is the source? Is that source primary and specific to the relevant jurisdiction? Who owns the assumption and is responsible for changing it? How sensitive is the valuation to the assumption? And what event would trigger an update? Imagine a carbon price assumption has not changed for a year. That may be fine if the regulatory environment has been stable. It may be unacceptable if legislation, free allocation or market prices changed materially during the year. Sensitivity matters because not every assumption deserves the same governance effort. If changing a parameter barely moves valuation, it is lower priority. If a small change moves enterprise value by 10%, you need much stronger evidence and monitoring. So the analyst habit is simple. High impact assumptions need a date, source, owner and trigger. You may hear examples where an AI-assisted estimate produced the wrong conclusion. The important lesson is not that AI is uniquely unreliable. A human-built spreadsheet can fail in exactly the same way. The deeper issue is model risk and assumption governance. A calculation can be mathematically correct while the economic conclusion is wrong because the world changed and the model did not. So rather than saying AI got it wrong, ask what part of the analytical system failed. Was the source outdated? Was the assumption not refreshed? Was there no owner? Was there no trigger to rerun the model when policy changed? For investors, the practical lesson is to refresh assumptions before pricing confidence. Technology may accelerate analysis, but it does not remove the need for judgment, evidence, and governance. We now have a quantified effect and a view of the model risks. The next step is reporting. This block is important because students often blur two things together. the financial statements and sustainability related financial disclosures. They are connected, but they are not identical. A sustainability risk can influence accounting estimates in the financial statements and also create disclosure requirements about the risk, assumptions, and expected effects. As an investor, you need to read both pathways and look for consistency between them. On the left is the financial reporting pathway. A sustainability driver, say higher carbon cost or an asset that may become uneconomic, can affect an accounting estimate. That may mean impairment, a provision, a revised useful life, different depreciation, or capital expenditure. Those effects appear in the income statement, balance sheet, or cash flow statement. On the right is the sustainability disclosure pathway. The company identifies a material risk or opportunity, explains how it may affect financial position, performance, or cash flows, and provides metrics, assumptions, scenario information, and governance. Under IFRS S1/S2 and for this UK listed case, the UK SRS pathway, that information is intended to be useful to users of general purpose financial reports. For an analyst, the key question is consistency. If management describes a major transition risk in the sustainability disclosure, but the financial statements assume long asset lives and no impairment pressure, is that coherent? Maybe it is, but you should ask why. The investor reads across the two reporting systems, not just within one of them. We only need a limited amount of standards knowledge for this class. IFRS S1 provides the general requirements for sustainability related financial information intended to be useful to investors and other users of general purpose financial reports. IFRS S2 focuses specifically on climate related risks and opportunities. For our purposes, the important point is not memorizing paragraph numbers. It is understanding the direction of travel. Companies are being asked to connect sustainability related risks and opportunities to financial position, financial performance, and cash flows, and to explain important assumptions and governance around those effects. The ISSB standards themselves apply for annual reporting periods beginning on or after the 1st of January 2024, but a UK listed company like Northbridge sits on the UK adoption pathway. The UK has issued UK SRS S1 and UK SRS S2 as the UK endorsed versions for voluntary use, and the FCA has consulted on listed company disclosure requirements aligned to that pathway from 2027. As analysts, treat the disclosure as evidence, not as truth by default. The standard can improve structure and comparability, but you still need to test the assumptions and economic mechanism. Now ask a practical question. At what point in this ladder would you personally be willing to change your valuation model? A narrative claim is the weakest starting point. A metric is better, but we still need to know where it came from. A documented source improves traceability. Then we need explicit assumptions. A calculation shows how inputs became an output. A mapped financial effect tells us where the economics enter the accounts. And approval plus an audit trail shows that the process has governance behind it. Notice that each step adds a different type of confidence. None of them makes the estimate automatically correct, but a stronger evidence chain gives the analyst more reason to rely on the quantified effect and less reason to apply an additional uncertainty discount. When you read a climate disclosure, ask yourself, how far up this ladder has the company actually taken me? Assurance can improve confidence, but we should be precise about what kind of confidence it provides. An assurance process may help verify that data can be traced to source, calculations are performed consistently, controls were followed, and approvals occurred. That is valuable. It makes the reporting process more reliable. But assurance does not necessarily tell you whether management has chosen the best economic scenario. It does not guarantee that pass-through assumptions are realistic. It does not tell you whether the market has already priced the risk. And it certainly does not decide how much you should adjust your valuation. So think of assurance as process confidence, not a substitute for analytical skepticism. A well-assured number can still depend on an assumption you disagree with. The analyst's job is to understand what has been assured, what has not, and where judgment still sits. We have reached the final block. We started with one sentence in a sustainability disclosure. We have now tested relevance, built the mechanism, inspected the assumptions, and judged the evidence chain. Now we are finally ready to ask the equity investment question. What should change in the valuation model? The answer will depend on the transmission channel. We do not create a separate sustainability universe. We adjust the same variables we already use to value businesses. There are four common routes into valuation. The first is cash flow. Higher carbon cost, transition capex, and energy savings can directly change forecast free cash flow. The second is the balance sheet. Impairments, provisions, or shorter asset lives can change carrying values and influence terminal assumptions. The third route is financing. If sustainability related cash pressure weakens covenant headroom or makes refinancing more expensive, the effect can appear in the cost of debt ERC or the equity risk premium. ERC is the weighted average cost of capital, the blended return required by debt and equity providers. The equity risk premium is the extra return equity investors demand for bearing equity risk. The fourth route is scenario probability. If policy outcomes are genuinely uncertain, you may model multiple scenarios and weight them rather than force one-point estimate into the base case. This is why an arbitrary ESG discount is analytically weak. Two companies can face the same climate issue and have completely different financial transmission mechanisms. The valuation adjustment should reflect the economics of the specific business. Let us make the effect visible using a simple bridge. Start with a base enterprise value of 100 index points. Our quantified carbon cost exposure reduces value by roughly 6 points. The near-term transition capex program reduces another 7 because cash leaves the business earlier. Some of that investment creates energy savings, adding about 4 points back. Then we include a further 5-point reduction from refinancing and wax pressure. The result is an adjusted enterprise value of roughly 86. Do not focus on the exact percentages. This is a teaching bridge, not a stock recommendation. Focus on the logic. Every adjustment has a named mechanism. Carbon cost is not the same as capex. Capex is not the same as financing risk. Energy savings offset part of the downside. A good sustainability adjusted valuation should allow you to explain each bridge item in ordinary financial language. Now let us put some pounds around the bridge. North Bridge starts with EBITDA of about 504 million pounds. After our net carbon cost assumption, adjusted EBITDA falls to around 483 million pounds. Base capex is 140 million pounds. The transition program takes it to about 175 million pounds in the relevant period. The combined operating and investment effects reduce free cash flow from roughly 205 million pounds to 158 million pounds. Because we have also assumed some refinancing and covenant pressure, the discount rate moves from 8.0 to 8.4%. In this simplified DCF, that means the weighted cost of capital rises by 40 basis points. When we run those changes through the model, enterprise value falls from about 3.10 billion pounds to about 2.66 billion pounds. Again, the teaching point is not that these are the correct Northbridge numbers. Northbridge is fictional. The teaching point is that the original sustainability sentence became priceable only after we translated it into explicit model variables supported by assumptions. Here is the checklist I want you to use after this class. First, what exactly is the claim? Rewrite it in precise language if necessary. Second, why is it financially relevant? Identify the enterprise value lever. Third, through what economic mechanism does the issue affect the company? Fourth, what assumptions produce the number? Look for policy, price, timing, boundary, pass-through and abatement assumptions. Fifth, what evidence and governance make the number credible? Ask about source, date, owner, approval and assurance. And sixth, which variable in the valuation model should change? If you cannot answer that final question, you may not yet have enough information to price the disclosure. These 6 questions are deliberately simple. You can apply them to carbon pricing, water risk, product regulation, supply chain labor issues, biodiversity exposure, or many other sustainability topics. If I show software during the session, I want you to treat it as a window into the machinery, not as a product demonstration. There is one strict guardrail. The live screen must reconcile to the teaching case. 21 million pounds net carbon cost, 483 million pounds EBITDA, 8.4% WACC, 2.66 billion pounds enterprise value, and an 86 index bridge. If the system is not locked to those numbers, the safer choice is to keep this as a concept-only illustration for the first outing. First, we would see the claim registry, what exactly management assisted, then the evidence pack, the documents, data, owner and date that support the claim. Next comes the assumption model, where policy paths and scenarios are explicit. The financial mapping connects the effect to statement line items. The approval trail shows who reviewed the estimate and what changed. Finally, the valuation export turns the result into an analyst-ready bridge. Why show this? Because it makes an abstract point concrete. Reliable disclosure is not created by writing a polished paragraph at the end of the process. It depends on a chain of evidence, assumptions, calculations, and governance underneath. As investors, understanding that machinery helps us ask better questions when the machinery is invisible. Your take-home exercise is intentionally small. Pick one climate-related disclosure from a real listed company. Quote one claim, just one sentence. Then identify the enterprise value lever it could affect. Is it revenue, operating cost, capex, asset value, liability, financing, or something else? Next, list the assumptions you would need before you could price the claim. Finally, say which valuation variable you would change or explain why you would not change anything yet. The important constraint is this: do not give me an ESG score and do not write a generic sustainability summary. I want investor reasoning. One claim, one transmission mechanism, one assumption set, and one valuation decision. If your conclusion is, I would not price this yet because the disclosure lacks enough evidence, that can be an excellent answer, provided you explain what evidence is missing. This is the structure we have just followed. The first 10 minutes establish the Northbridge claim and the question, would you put this in your model? Then we spend 15 minutes on relevance, 20 minutes mapping the mechanism and assumptions, around 12 minutes on failure risk, 13 minutes on evidence and governance, and 15 minutes on the valuation bridge. The final 5 minutes return to the investor checklist. The reason for showing you the structure is that the sequence matters. If we started with DCF adjustments, we would be pretending we already trusted the number. If we started with reporting standards, we might lose the connection to investment decisions. The discipline is to earn the valuation adjustment step by step. Let us finish where we started. Sustainability information becomes investment grade only when it survives the journey from claim to evidence, assumption, financial effect, and valuation input. Go back to Northbridge's original sentence. Carbon pricing developments may materially affect operating costs and future investment requirements. At the beginning of the session, that was too vague to price. Now we know what questions to ask. We know how to model exposure, how to challenge the assumptions, how to look for consistency across reporting, how to judge the evidence chain, and how to adjust a valuation variable. So your final decision does not have to be simply yes or no. You have three sensible choices. Price the effect now because the evidence is strong enough. Price it with a wider uncertainty range or scenario weighting, or demand more evidence before changing the model. That is the investor mindset I want you to take away. These references sit behind the session, but they are not the center of the teaching experience. IFRS S1 gives us the general architecture for sustainability related financial information useful to investors. IFRS S2 brings the climate specific lens. IAS 36 and related educational material are useful when we think about how climate related matters may interact with impairment and other financial statement judgments. The ISB's work on uncertainties in the financial statements is also relevant because it reinforces the need to explain significant uncertainty and assumptions clearly. For students, however, the objective is not to memorize standards language. Use the standards as a source of evidence and structure. Keep returning to the analytical question. What is the claim? What supports it? What assumptions create the financial effect? And what should I do with that effect in valuation? If you can do that consistently, you are already reading sustainability disclosure differently from someone who only reads the headline.